Hello, everyone. I'm Peter Towers, Managing Director of Towers Business Development. Welcome to this conversation on predictive accounting. Helps businesses to be able to identify their financial picture. So thanks for being with us. If you have any questions during this presentation, please send me a note through chat, or if you're watching this video at a time more convenient for you, why don't you send me an email on any questions that you have or suggestions on the type of information you're interested in hearing about that accountants with experience in virtual chief financial officer services could present to you in this series of webinars. So let's move on. Predictive accounting, what is it? It's a relative new term. It's really the financial interpretation of what's contained in a business plan. Because when you prepare a business plan, and many of you will have utilized facilitators, people like myself, who will have assisted you to prepare a business plan. And one of the key things that we're looking for is to identify your vision. Where do you want to take your business to? What do you want to achieve? And that would follow on after having a close examination of the strengths, weaknesses, opportunities, and threats of your business and your competitors, and getting input from your leadership team and your other team members. What do they think about the business? What do they think about the customers? What do they think about the threats from competitors? Do they like the products? Do they like the training that you're offering to them? Do they see it as a career or just something that they're turning up to do at present while they're looking for something else? So what is the vision of your business? And it's all very well to have visions, and we can write pages and pages on a vision, but you then must be able to implement. And this is done by identifying strategies and then implementing those strategies, which will enable the vision to be achieved. Now, visions take a while to implement at times. It might be 2, 3, 4, 5 years' time, or even longer in some instances. Now, this is all documented by a 3-way forecasting process, is what Plan Guru, the instigator of this concept, because they developed the accounting software to facilitate this great process occurring. But I think it could be called a 4-way forecasting process, and I'll show you why in a moment. And the reason I think there's 4 ways is the first one, the key drivers. They're not included in the 3-way forecasting process description, but this is vital. It's like laying the foundations to build a building. You need to have your key drivers clearly thought out. And instead of making all sorts of adjustments and calculations in the budgets or the cash flow forecast, the whole idea is you do them off the chart, if you like, on a separate area altogether, which we call the key drivers. We then also have the income statements or the budgets, which is where all the information is collated. You can then analyze it. You can look at things like average sales and gross profit percentages and productivity of team members, and compare it back to your budget and to what's been achieved in the past to make sure it's not an outlandish projection. And the information then needs to be reflected in the cash flow forecast. And this is a vital document because this will show you whether the business is going to run out of money. Because as you grow a business, you find that you've got to give credit to more and more people. And if they're taking well beyond the traditional 30 days to make their payments in, they're taking 70, 80, 90 days, but your creditors are demanding that you pay them within 30 days, and a significant amount of your expenditure is on wages, so you're paying wages every week or fortnight. Even though your business is growing and potentially making attractive profits you could be running out of money. So the cash flow forecast is very important for us to clearly understand what's happening in that very important engine room for the business. And the third component of the three-way forecasting concept is the predicted balance sheet. What's this business going to look like? Pardon me, in a few years' time? Perhaps 5 years' time. What's the balance sheet going to look like? Dashboards can also be prepared, which is really a summary of key performance indicators that are calculated on the budgets, can be compared to previous financial accounts and to your previous budgets to make sure that something hasn't gone wrong in the calculations and we don't have outlandish type forecasts coming out that are obviously incorrect and need to be changed. So let's have a look at a business plan, because I'm saying this is where this process starts. It's normally prepared by a facilitator, someone like myself, working with the leadership team and the directors to go through the issues. But I think it's also a great idea to have input from the total team, not just the leaders. Bring them all together, maybe for 2, maybe 3 hours, workshop it. Try to make sure that they'll be honest and give their honest opinion on the business and what can be changed and what they think of the customers and the suppliers. Are they being trained to do their jobs properly? Do they see careers? Do they see that they're going to be part of a succession plan within the business? And then we're going to have documents the business strategy under various subject headings. When you do a business plan, there's probably at least 40 key headings that are considered. SWOT analysis, SWOT on competitors, marketing, website, products that have been produced, investment in inventory, capital situation, dealing with the bank, dealing with your accountants or your solicitors. It's a whole range of issues. And part of that's going to be that it identifies the vision and the strategies to implement the vision. Visions don't get achieved unless there's a real concerted effort by everyone involved, but most definitely the leadership team to implement the vision. Anyone can write anything on a piece of paper and put it into a business plan. It's implementing that's important. And this is where many SME businesses need assistance from external advisors, people who are not actually there in the day-to-day process of the business. And I can help you in that role if you wish. And some of these strategies are going to refer to financial matters, sales, costs, marketing expenditure, capital raising, capital expenditure, negotiating with the bank for an increase in facilities. So let's look at some of the key drivers. Now, many of these are non-financial items, and you might be surprised that they're part of a financial document. But budgets and cash flow forecasts are drawing information from all over. And some of these are not normally items that appear in traditional accounting reports, but they're very important in establishing the financial picture of a business. What's it going to look like? This is the financial picture that's interpreted out of the business plan. So the key drivers, I think, start with sales estimates. What do your sales team think can be sold in the marketplace? And at what price? And at what times of the year? And therefore, once the sales information is known, production targets can be set. It's no use producing 1 million widgets if the sales department's telling you they can only sell 300,000. So what are the production targets? And is there going to be a need for stockpiling certain times of the year because certain raw materials that are vital to the process are not able to be obtained because of seasonal conditions or climatic conditions or whatever, or just because it's anticipated that the supplier organization in an overseas country might have trouble delivering at certain times in the year. What are the energy requirements likely to be for this production run? And if you're running a factory or a workshop, you'll obviously know that your various machines, the big ones, use electricity or fuel oil or gas, and you'll know the quantity of that input that they utilize to produce certain production targets. What materials are going to be required? And even now, someone in the organization should be thinking, geez, can we get that quantity of particular materials? We've been buying a lesser quantity for years off a supplier. Are we going to be able to increase the order by 45% or whatever? And that's going to require in the key drivers a raw materials inventory to be kept, especially if there's going to be the need to stockpile some raw materials to make sure that the production can be continued throughout the year on a fairly even basis. What team's going to be required for the production of the quantity that's been set out in the production targets? And what classification are they? Manager, leading hands, foreman, tradies, trades assistants, some apprentices, some general labourers. What else is going to be required? Truck drivers. And then the administration staff to keep the paperwork going. So what's the team? And what will the labour on cost will be? Especially if you've got people working shift work, is there special rates got to be paid to them? Or does the business pay those to them on a voluntary basis? We can then start looking at creditors. What's the creditors forecast? And you could break that down into components of creditors if you wish. And you might have some classification. You might call them grade A creditors, grade B, grade C, because you may have negotiated particular payment terms with some of those creditors. Some of them may have agreed that you've got 80 days payment terms, or even longer in some instances. Well, you treat them different in your forecast, wouldn't you? Because they're probably your very big suppliers, and you've negotiated very favorable terms. So it's no use paying them any earlier than what you've negotiated. It's 80 days. That's when you'll be making those payments. So in this planning process, this all needs to be taken into account. But others, of course, may have you on 7-day payments. And you need to make sure that you're going to provide that you're going to pay them then, and that you've got sufficient cash when we get to the cash flow to be able to make those payments to them. What are the marketing costs? And what's the marketing department saying that they want funding allocated to them? I've noticed marketing people all want to know what their budget is. It always intrigues me. They never seem to come back to you and say, this is what we would like to have available. I found they're always coming to me first and saying, well, how much are you going to allocate us in the marketing budget? Now, my reply to them is, you go away and prepare a plan. Tell me what you would like to do. You're supposed to be the experts. What are we going to do in marketing? Bearing in mind what the sales forecast. What are the sales departments saying they think they can sell? And what's marketing now saying has got to be spent to achieve that? I don't like it the other way around. That's my preference. I hope you don't mind me expressing that to you. Completed products and inventory, especially if we've got a stockpile. How much is going to be in there? Because there's a lot of money tied up whenever you create inventories, isn't there? What are the selling costs? We've had marketing costs. Is there special selling costs? There might be bonuses being paid to representatives or salespeople or distributors all around the all around the world if you're an exporter. And what's the sales planning strategy? How are we going to get these customers? How many people need to be contacted? It's like a funnel, isn't it? And we have forms which would assist you in understanding this, to say, what are we going to put up at the top of this funnel? What's the input? And we've got to go out and talk to 10,000 potential customers, because we want to ultimately deal with 700 of them, and they will give us the sales budget we're looking for. But we know we've got to filter down through a funnel to find the people. So the sales planning strategy is not normally shown in a budget or a cash flow forecast, but it's pretty important, because this is then going to have a real bearing on what's in the marketing budget, isn't it? Because I'd be saying to the marketing person, well, how many people do you think we've got to contact to get 700 paying customers at the end of the year who are going to pay us some astronomical amount of money probably on that little exercise? And have you taken that into account? Because what have you got to do with those 10,000 people? How much is it going to cost you in each presentation pack or whatever? How many TV ads are you going to want to run? How many videos are you going to produce? So that's very important. And out of all that, of course, we've now got a sales budget. This is what we're going to achieve in sales. And then that allows us to calculate a debtors forecast. But then the other, just like creditors, have we negotiated special terms with some of our customers? Have we now acted very generously and said to some of our customers, who your customers, you can have 90 days to pay us? Now that's going to be factored into the cash flow forecast. So if you've got a group of customers that you've negotiated very favorable trading terms from their point of view, the benefits for you might be that you get their business. But you need to factor this in. They're not all going to be paying you in 30 days. In fact, what are they paying you? And if traditionally the average payments has been 83 days, don't do a budget saying everyone's going to pay in 32 days, because they won't. And you're going to be well short of money. So we need to look closely at the debtors. Loan funds. If you've already got loan funds from a bank or a financier, the key driver summary will show when the payments are going to be made, so we can slot that into the cash flow. And we can put the interest into the budget as an expense, obviously. But what other loan funds might be necessary? And some of this you mightn't determine until you start looking at the cash flow forecast, because you've got a whole stack of these customers that the sales manager is told they can pay on a 90-day basis, and that's completely mucked up the cash flow forecast. So maybe the leadership team or the directors and any other shareholders you've got are going to be asked to put in some special loan funds to carry you over. So that can be summarized in the loan funds. Taxation payments. I left it to last. Companies this year are paying 26%. That's small companies. And next year, that tax rate goes to 25%. There's no further drops after that. But you have to pay tax on a quarterly installment basis. Not like the old days where you used to lodge a tax return and 3 months later you'd get a bill and then you had to pay it. We now have these quarterly payments. So they need to be factored into the key driver section, so they can be slotted into the cash flow forecast. And there needs to be communication with your accountants to make sure that all the processes that you need to undertake relative to your tax returns have been done. Perhaps you show that there is a shortage and The business is wanting to undertake significant expansion, capital expenditure, and the board of directors have made the decision they'd like to raise some capital. And the options are Section 708 of the Corporations Act. You can raise up to $2 million in a 12-month period. You can't keep on doing that forever because the 50 shareholder limit for a private company rears its head and will stop you doing that. But you could look at crowdsourced funding, equity raising. A private company can raise up to $5 million in that way, and there's no shareholder number limit. And you can come back the following year and raise another $5 million if you wish, as long as the market supports you. There's a whole process to go through, and I can take you through that. I'm very experienced in that area. And if you're a very young company that's invented a new product, process, or service, you could look at early stage innovation company, which is a classification that will assist a young company that's undertaken some research and development type work and wants to commercialize that R&D. Gives them some favorable status to be able to raise capital because the investors get something out of it. They can minimize their income tax by 20% of their investment in the company. And if they hold the shares in the company for longer than 12 months, pardon me, they avoid capital gains tax. So there are some investors out there that think that's pretty smart and they'll be interested in doing that. So there are capital raising opportunities. And I mentioned capital expenditure projects first. That's probably preceded the capital raising because it's the companies wanting to expand is the reason they need to raise some extra funds. And you've heard about capital raising because you can raise capital without any security, with no personal guarantees, with no monthly principal and interest repayments. Sounds good, doesn't it? There is a process. So let's now look at the income statements or the budgets. The information is uploaded from those key drivers. It relates to the budgets, it goes to the budgets. You can then calculate the key performance indicators. It's great to check the figures. What's the gross profit percentage? The first thing I ever look at in every bit of financial information. It's what you should be doing if you're in the leadership team of any business. What's the gross profit percentages? And if traditionally you're making 42% and the forecast is showing 78, unfortunately, there's a mistake. You need to go back and redo it. So calculate the KPIs, things like gross profit percentage. Sales per employee is another one. If your average sales are 135,000, I don't think it will be 210,000 if that's what the budget's showing. There's been a mistake made. And it's better to find that out now than to start the process and then find the budget is well out. So you can do comparison to previous years. Let's now look at the cash flow forecast. Some of the basic information comes from the key drivers. But then the big question, is there adequate funding? And I've alluded to that already. If there's capital expenditure. And what changes could be made? You might sit and look at it and say, well, we can't have these customers paying us on a 90-day basis. But it might be too late. The sales manager's committed. I hope you got senior management's approval. Will performance be within banking approvals? Your bank may have specified some pretty strict lending requirements. And if you want to raise some more loan funds from them, are they going to agree? So is there this need for additional loans or capital raising? The predicted balance sheet. Also, a lot of the information comes from the key drivers. But it's the financial picture of what your business is going to look like in the future. This is what all the hard work in 4 years' time will show us within a balance sheet. And hopefully you've created intellectual property and systems that would enable the company or business then to be valued at a higher multiplier when the after-tax profit is multiplied to basically determine the value of the business. And this is one of the reasons you're doing all this, because the more systems and processes you put in place, similar to what a large company does, the better chance you have of being able to convince your bank or potential investors or a potential buyout operator in the future that your multiplier should be a lot higher than the traditional 4 or 5 that applies to private companies in Australia. Maybe getting up around 8 or 9 means a lot when you multiply that by your after-tax profit. So business plans, budgets, and cash flow forecasts are very important. Every business needs them. And hopefully I've demonstrated you in this short discussion the linkage that goes on. They're not separate. They're all linked items that tell you a picture, a financial picture. This new year, which is about to start, is going to be very challenging for a lot of businesses. There's a lot of catching up to be done through a dismal 2020-21. So I suggest to you, you need these documents. You need, though, to have sat down and thought it through. And many SMEs will need to work through with a professional. And many of you will find that your accountants are too busy sorting out end of financial year tax matters for their clients. So you might be interested in talking to a consulting firm like myself. I did prepare income tax returns for many years, but we've been a consulting firm now since 2000, and we're interested in talking to you. Have you developed your plans, your vision, your strategies, the financial picture? Want more information on the services that we could supply to you? Why don't you visit our website and have a look, www.towersbusiness.com.au, or send me an email, peter@towersbusiness.com.au, or you can telephone me, 1-800-232-088. And I overlooked, I haven't checked if anyone has got any questions. I did have a quick look at one stage and there was none there. I've got no questions. So more importantly, if you have some questions now, having watched this in your own time or at a time more convenient to you, please send me an email and I will get back to you and give you a reply. And if you'd like to talk to me about any aspect of what I've discussed today, please don't hesitate. 1-800-232-088. Have a great day. Goodbye. And I hope everything goes all right for you and your colleagues in this fast approaching new financial year. Have a great day.